Your Social Security check is built from exactly 35 years of your working life. Not your best year, not your last year, 35 of them. And if you work 31 years, the other 4 are not left out of the math. They go in as zeros. 4 zeros, averaged in with everything else you ever earned. That is not a penalty, and it is not a mistake. It is simply how the formula is written. And once you can see it, a whole set of decisions in your 60s suddenly make sense. Whether one more working year is worth it, whether the part-time job matters, and whether the numbers the agency has on file for you are even correct, because the calculation is only as good as the record it is reading from. I am going to walk you through all of it. What the 35 years actually means, how to pull up your own record tonight, the 3 errors that show up most often, and the deadline for fixing them, which has a piece almost nobody quotes correctly. Let me start with the formula itself, in plain language. The agency takes every year you have ever had earnings that were subject to Social Security tax. It adjusts the older years for wage growth. So a year you earned $12,000 in the 1980s is not compared directly against the year you earned $60,000 recently. That adjustment is called indexing, and it is done for you automatically. Then it lines those adjusted years up and picks the 35 highest. If you have more than 35 years of earnings, the extra years simply do not count. Only the top 35 make it in. If you have fewer than 35 years, the missing slots are filled with zeros, and those zeros are averaged in exactly like a real year. Then the total of those 35 years is divided by 420. That is 35 years times 12 months. The result is a monthly average, and everything else the agency calculates about your benefit starts from that number. I want you to hold on to 2 things from that description. The first is that this is an average, not a total. A single enormous year does not rescue a thin record, and a single bad year does not ruin a good one. Everything gets diluted across 35 slots. The second is the part that matters most for people watching this. A 0 is not neutral. It is a full slot in the average, holding the value of nothing. So let me put arithmetic on it, because the shape of this is easier to feel than to describe. Imagine somebody with 31 years of covered work. 4 slots get zeros. Take their real average across the years they did work. Now dilute that same total across 35 slots instead of 31. The number that comes out lands somewhere in the neighborhood of 11% lower before anything else is applied. Now flip it. Imagine that same person works 4 more years at any wage at all, and those 4 years replace the 4 zeros. Every one of those years is pure gain because it is replacing nothing. That is the single most useful thing in this whole episode, and I want to say it as clearly as I can. When you have zeros in your record, an extra working year does not have to be a great year to help you. It only has to beat a 0, and everything beats a 0. Compare that to somebody who already has 40 years of solid earnings. For them, 1 more year only helps if it is high enough to knock out the lowest of their existing 35. Same extra year of work, completely different value, and the difference is sitting in their earnings record, not in their paycheck. So who tends to have zeros? People who took years out to raise children. People who cared for a parent. People who worked in jobs not covered by Social Security, like some state and local government positions. People who were self-employed and reported very little in the early years. People who were sick or laid off during a long stretch. People who came to this country partway through their working life. None of that is a moral failing, and none of it is unusual. But the formula does not know the reason. It just sees an empty slot. Which brings me to the part I actually want you to do something about. The whole calculation is done from a record. That record is a list of your earnings, year by year, from the beginning of your working life. And that record can be wrong. Let me tell you how it gets wrong, because it is almost never dramatic. The first way is a name change. Somebody gets married or divorced. The name on the payroll system does not match the name on file with the agency, and a year of earnings gets posted to a holding file instead of your record. Nothing looks wrong on your paycheck. The tax came out. It just did not land where it belongs. The second way is a wrong digit in a Social Security number. One transposed pair in a payroll entry, and the earnings go to somebody else's record or to nobody's. The third way is an employer that reported late reported wrong, or went out of business in the middle of a year and never filed the final report at all. And there is a fourth that catches self-employed people specifically. If you filed a tax return and paid self-employment tax, but the return was filed very late, or there was a mismatch in how the income was reported, that income may not have posted the way you think it did. Notice what all four have in common. In every case, the money was earned and the tax was almost certainly paid. The failure is in the recording, and the only person who is going to catch it is you. So here is how you check. It takes about 15 minutes, and you can do it tonight. Go to the agency's own website and set up your personal account there. Type the address in yourself. Do not click through from an email. Do not click through from a text message. And do not use a search result that says it will help you with your Social Security account. The real address is sa.gov, typed in directly, and setting up the account is free. Anyone charging you a fee for it is not the agency. Once you are in, look for your earnings record. It is a plain table. Left column is the year. Right columns are the earnings that were posted for that year. Now read it like this. First, look for years that are blank or show nothing where you know you were working. That is the obvious one, and it is the one that matters most, because a blank year is a candidate 0. Second, look for years where the number is obviously too low. Not slightly off, but half of what it should have been, or a couple of $1,000s in a year you worked full-time. That usually means one employer out of 2 reported and the other did not. Third, count how many years actually have earnings in them. If the answer is under 35, you now know exactly how many zeros are sitting in your calculation, and you can make decisions with that number instead of guessing. Fourth, do this while you still have the paperwork, which brings me to the deadline. Ordinarily, an earnings record cannot be corrected after 3 years, 3 months, and 15 days from the end of the tax year in which the wages were paid. That is the rule. People, quote, usually in a panic, and it is real. But it is only half the rule. And the other half is the reason I am not telling you to give up on anything. The agency's own material lists specific situations where a record can still be corrected after that time limit has passed. It can be corrected to make the record agree with a tax return that was filed with the Internal Revenue Service. It can be corrected when the error came from an employer omitting somebody from a report that was processed, or from a report that was missing entirely. It can be corrected when the error is visible on the face of the record itself, and it can be corrected to include wages an employer reported as paid to a person that are not showing in the agency's records. Read that list again, because between those exceptions sits most of what actually goes wrong in real life. The name change case, the transposed digit, the employer who never filed. Those are exactly the categories that the exceptions describe. What they have in common is evidence. If you can produce a document showing the earnings existed, you are in much better shape than the plain 3-year rule suggests. So the practical version is this. The time limit is real, and you should not wait. But if you are past it and you have proof, do not assume the door is closed. Ask, now, what counts as proof? A W-2 from that year. Pay stubs, especially one that shows year-to-date totals. A tax return with the schedule that reported self-employment income. A written statement from the employer. Even a bank record showing the deposits can help support the rest, though on its own it is weak, because a deposit does not prove what was withheld. If you cannot find any of it, you can still report the problem. The agency has a form for reporting an error in an earnings record, SSA 708, and it exists precisely so a person can put the details in writing and start the process. Fill that form out with everything you can remember, the employer name, the address, the dates you worked, roughly what you were paid, and file it. You are not required to solve the case yourself. I want to add a word of realism here, because I do not like promising outcomes. Some of these get fixed in a few weeks. Some take much longer, and some cannot be fixed at all because there is genuinely nothing left to verify the earnings against. What I can tell you is that the ones that get fixed are almost always the ones where somebody looked at the record, noticed the gap, and pushed. Nobody at the agency is going to notice on your behalf, because from their side, the record simply reads as a year you did not work. One more thing before the questions, because it decides whether any of this actually gets done. Print the earnings table or save it as a file the first time you look at it, not because you need it today, but because next year you will want to compare. A record that changes between one year and the next, in a year you did not work, tells you something is being posted to your number that is not yours. That is rare, and it is exactly the sort of thing nobody catches without an old copy to compare against. And if you are helping a parent with this, do it while they can still tell you where they worked. The record is a list of numbers with no employer names attached in the way you would expect. So the person who can look at a blank year and say, "I was at the cannery that whole summer," is doing work that no document can do later. Half an hour at a kitchen table with the table on a laptop screen is worth more than any amount of digging through boxes afterward. Let me answer the questions that always come up on this subject. The first one: does the record show earnings from every job I ever had, even short ones? It should show any employment where Social Security tax was withheld, including short jobs, part-time jobs, and seasonal work. What it will not show is work that was not covered by Social Security, which includes certain government employment. It also will not show income that was never reported at all, including work paid in cash that never went on a return. The second one: I am already receiving benefits. Is it too late for me? No. Records are corrected for people already receiving benefits, and when a correction goes through, the benefit is recalculated. Do not skip checking simply because you have already filed. The third one: I have more than 35 years already. Should I still look? Yes, and here is why. Extra years do not add anything by themselves, but an error in one of your high years can quietly push a good year out of your top 35 and replace it with a lower one. The effect is smaller than a missing year, but it is not nothing. The fourth one: will working one more year at a low wage lower my average? Only if you already have 35 years of earnings and the new year is lower than the lowest one currently counted, and even then it does not replace anything unless it is higher. If you have zeros, a low year cannot hurt you. It can only replace a zero, and that is an improvement by definition. The fifth one, and I get this constantly: is there a way to buy or add missing years? No. There is no mechanism to purchase credits or fill an empty year retroactively. The only ways an empty year gets filled are working another year, or correcting a record that should have shown earnings all along. Let me pull this together into something you can act on. Your benefit comes from 35 years of indexed earnings, divided by 420 months. Fewer than 35 years of work means zeros go into that average, and each zero pulls it down. Which means, for a person with gaps, one more year of any earnings at all is worth more than most people assume. The record those 35 years come from can contain errors, and the four common ones are a name change, a wrong digit, an employer that never reported, and self-employment income that never posted correctly. The tax was paid. The recording failed. You can check the whole thing tonight for free in your own account on the agency's website, typed in directly. Look for blank years, look for years that are far too low, and count how many years actually have earnings. The correction time limit is 3 years, 3 months, and 15 days from the end of the tax year. But the agency's own rules list exceptions, including agreeing with a filed tax return, and including wages, an employer reported that are not in the record. Evidence is what opens those doors. So if you find a problem, gather the W-2 or the pay stub before you call. Here is your assignment for this week, and it is one thing, not 5. Open your account, look at the earnings table, and count the years that have numbers in them. Just count. If the answer is 35 or more, you know the zeros are not your issue and you can stop worrying about that particular thing. If it is fewer, write the number down, because that number changes how you should think about every remaining working year you have. And if you find a blank year that should not be blank, go looking for the paperwork this week rather than next year. That is the whole difference between a record that gets corrected and one that does not. Tell me in the comments how many years showed up in your record, and whether anything in it surprised you. People compare notes in these comments better than any article can explain it, and somebody watching is about to check theirs for the first time. Thanks for watching. If this was useful, the episode on how the claiming age changes the amount is the natural next one. because that decision sits on top of the number we just talked about. See you in the next one.